if you're underinsured by a percentage, they will pay you out less that percentage that you're underinsured. That shocked me because that hurts the hip pocket. All of a sudden, you're underinsured, and then you're not even going to get paid out what you're insured for.
Yeah.
Can you run us through that?
It's called the co-insurance clause, and it's pretty much in every policy as far as I understand it. So what that means is that, let's say you've got a house that would cost $1 million to rebuild, and you have it insured for $800,000. If that was to burn down or be demolished, the insurance company would say, okay, well, you've elected to underinsure that by 20%. So what we're going to do is we're going to give you 20% less than the insured amount you have with us.
Wow.
So they're going to take 20% off that 800,000.
I would beg to differ that 99% of people do not know that. What if you're overinsured? Is there any...
Well, you can reduce your insured amount.
But if your house was to burn down and you were overinsured...
I don't think you get to pocket the surplus. That would be nice.
Property transactions can be among the most significant financial decisions of your life.
We are here to guide you, debunk the myths and misconceptions that cloud the industry, help you move forward confidently through your real estate journey, and give you a behind-the-curtain look into the world of real estate.
We're Michelle Tucker and Linda Johnson from Spring Buyers Agency and Spring Property Management.
And this is the Unreal Estate Podcast. Today we have an exciting episode of Unreal Estate Podcast. We have a very special guest, Mike Mortlock. Mike is a distinguished tax depreciation leader, co-founded MCG Quantity Surveyors with Marty Sadler in 2011, a while ago now, leading the firm to be featured in the AFR's Fast 100 in 2018. He's a seasoned consultant for many, many top-tier firms like McDonald's, Stockland, Hilton Hotels. He delivers comprehensive depreciation schedules and shapes industry standards as an advisory board member for many industry organisations. And he has been recognised as a top thought leader by Elite Agent magazine. So today we're going to talk about many industry trends and lots of interesting topics.
So excited to have you. Welcome,
like
Mike.
to write our own reviews, don't we?
Thanks for submitting that review.
You didn't read about part where it said he's really handsome and witty and charming. But anyway.
That bit. That goes without saying.
Oh, it's very sweet. No, I'm looking forward to this. I was hoping I'd get a call up one day for your show. You guys have been crushing it. I've been fans of your work for a couple of years now. And, you know, you're the perfect kind of like double act to do a podcast.
I get called Linda, she gets called Michelle. We answer to both. We talk in unison.
What's not to like?
But we are serious sometimes.
Well, at the end of the day, like I think what we do is very, very serious, right? Because I say we, like I mean, even more so for you guys, because we can get it wrong and we can make sure that we're not maximising someone's cash flow. But I talk more broadly about real estate. These are very important decisions. They might be the most important decisions they ever make financially. So you do have to take it seriously, but I think we can have fun along the way, and we tend to whenever we catch up.
Yes, we do.
We do. We manage to fit in a bit of fun, but when it's serious and on, it's on. So, yeah. So, yeah, we're super excited to dive into a few topics today with you, Mike. We've been on your podcast a little while back. That may have even been our first try or second into a podcast. So, yeah, how long have you been running Geared for Growth now? It's been a while, hasn't it?
It was May 2017. So that's, like 7 years now.
You're over 100 episodes, aren't you?
Oh, well, actually, it's hard to tell because we did like a special series where we reset the counter and then it's just sort of kept going. So, I don't know. And there's probably, I think, 300 plus.
Oh, wow.
Yeah.
Plus numerous other podcasts and things that you're regularly on and joint with other people. And
it's hard to get away from me once you get trapped in my little Spidey net.
It's great.
I hear that a lot. You're on this, you're on that. And I was thinking about that driving here. They're like, oh, they're going to see me on this. And like, gosh, another one.
Well, we're thrilled to have you.
No, I'm thrilled to be here. Thank you.
So let's get started. Why don't we just talk about the big elephant in the room, the market.
The market.
The market.
You know, we get taught that you can't just say the market because there's markets within markets.
Correct.
But there's been a few times in the last couple of years where it seems more appropriate to talk about the market, like things like vacancy rates. It's tight everywhere. Like property prices, they tend to have been doing pretty well since COVID, pretty much everywhere.
Yeah.
But there are some that kind of stand out with some interesting data and some metrics, and hopefully we can share some of that today.
Yeah, which would be great.
Because we've heard that you've done some quite extensive research and had some very interesting findings state by state and, as you say, micro markets within micro markets.
Yeah.
So I guess what are some interesting or standout trends from your perspective that you're seeing?
Yeah, look, probably the one of most interest over a fairly broad time scale to us is the distance people buy from where they live. Because we wanted to kind of attack that notion that all investors are fairly unsophisticated. They like to buy around the corner because they want to drive past it and go, I own that and I'm winning at life. Or, I want to make sure there's no meth lab being set up in there. But the first time we crunched that, it was just about 293 kilometres is the average distance people buy an investment property from where they actually live themselves.
That's interesting.
It was way bigger than I expected, way bigger. And that was 2019 pre-COVID. So it was very interesting to have a data set pre-COVID and then mid, and we've done that post. So it pretty much doubled. We went over 500 kilometres during the first year of COVID, up to 800. And in the last data set, it was 1,500 kilometres, which is mad because many countries aren't that far from north, south or east or west. But that tells the story of Perth for me. And Perth is you talk about state trends. When we looked at Perth as a percentage of every state in Australia where investors are buying, Q1 2022 was about 9% of investors buying in Perth, which is fairly solid compared to other states. Queensland was always leading the charge. Q1 2022, it got into the 30s. So from 9% to 30% of investors buying in WA. And we've seen it in the 40s and overtaking Brisbane as the most popular place to invest. So that is a very interesting thing, and you see it a lot on social media if you're part of the, where do I buy style groups. And there's a lot of vitriol for people that question Perth at the moment because they've got a pretty biased view of it, in my point, because they bought there, and why shouldn't they? But I think it's important to remember that there was a point in time where the median house price in Perth was higher than Sydney. I think people forget that. And there was also 16-year period where the median house price stayed at around 490. So that's why I kind of think, look, if you're looking at Perth today, just be careful because there's so much competition. The best time to buy was probably 2019, and that's a little bit of a worry. So those are some of the things that we've looked at. We looked at the land tax changes in Queensland. So that was actually legislated for what we calculated a 98-day period where people could buy in full knowledge that this would happen because it was law, right? It just hadn't actually, it was due to start 1 July. But we saw a 14% drop in investors purchasing in Brisbane or Queensland, which was pretty meaningful. On top of that, PropTrack was showing data on people selling in Queensland. And as recently as this morning, we had a press release where it was looking at Victoria. So compared to some of the other major states, there's a net loss of investment properties that we've forecasted for this year. And, Victoria gets its fair share of international migration. So it's got to be providing more housing, but we're seeing investors selling and we're seeing a really decreased pipeline of new investment in Victoria. So that's another kind of cautionary tale for policymakers around investment. You can disincentivize investors to the detriment of tenants. And we are in that crisis now.
We are. That's the talk of the town is the housing crisis.
Yeah.
How are we going to fix it?
Yeah, sorry, that was a lot of data.
No, there's a lot of that. My mind's spinning. There's so much that you just shared in there, and we're obviously seeing trends. People are becoming more comfortable investing outside their own state, as you said. You didn't mention a lot of people do invest in capital cities, but how are you seeing the regional parts of the country go with regards to investors?
Yeah, look, we don't tend to sort of segment it from capital cities to regions. I mean, we do have the data within our system for different SA3 or SA2 regions or whatever we want to slice it up, but the sample sizes tend to be smaller when we're looking at regions, and we like to look at a minimum of 1,000 transactions. But regions are still popular. They're still performing. I think 2023 for me was about affordability. It was those affordable markets that saw the lion's share of investment. WA, it was kind of the cheapest median value outside of Darwin, and people talk about WA as being risky with the mining exposure. Darwin is that on steroids.
Yeah.
But certainly we've seen regions within Queensland being quite popular to investors, places like
Townsville, isn't it?
for example. Yeah.
Budget-driven for
And
investors.
typically we would see places like Geelong, Bendigo and Ballarat being quite popular in markets like this, except for the land tax changes.
Yeah.
That ring of steel they set up, they're still paying for it, right?
Yeah.
They can't do the Commonwealth Games, and there's all sorts of terrible things going on there.
Do you think, so just reversing back when we first met, and you put out an article on LinkedIn about a really interesting topic, that the majority of investors have one property.
Yeah.
Is that still the case, or are you seeing a change with all, I guess a lot more media and TV shows and the rise of buyers agents? Are you seeing investors become more confident and be more strategic around their investments, or same?
Oh, look, it's marginal. So the data is still saying that your average person, which is 72.5, I think, % of investors own only one property, and 90%. Yeah, it is. 90% own two or less. So that's, very significant. I mean, I remember in the lead up to the previous election where Labor were talking about negative gearing, they were saying, well, why not focus on these people that you talk about, these mythical people that own 10, 20, 30 properties each. And, I remember the Treasurer then, Chris Bowen, saying, oh, yeah, we're looking at that. The reason why they never looked any further is because such a tiny percentage.
Yeah.
It increased in the last ATO tax stats. Unfortunately, we can only those stats are always delayed. I mean, we were only just not that long ago got the 2021 financial year stats, and we saw the percentage of people that own 6 or more at 0.8%. So less than 1% of investors own 6 or more. That's up a tiny bit from, I think, 0.6, but it's so tiny. And I remember when I started my podcast, I kind of thought, gee, that's a real good mission, is to move the needle, because I thought from a mission point of view, your average investor only owns one property, and there's a fairly strong argument to say that's not enough to fundamentally change a person's life. Depends where they buy. If they bought a place for $5 million in Mossman, it's probably enough. But for most people, it's not enough. And the numbers are still sort of saying most investors don't get past one property. And I think the main reason is because they get that first one wrong.
Yep.
They don't get the right advice. They don't use a buyer's agent. So it's high stakes stuff. So that's the serious part of when we're talking about we can have fun, but it is still serious.
It is very serious. And there's still a trend of investors offloading property at the moment. Are you still seeing that across the board, or more so in Victoria, given the...
Yeah, Victoria is the main one, and that was kind of the focus of the recent research that we did. And it's something that PropTrack have been sharing that as a story as well, because they can see the history of the property. Was it ever listed for rent in the last little while, and now is it for sale? I think there's probably a degree of demographic change. So there's probably a few baby boomers that are selling down, which would be a natural thing normally, but baby boomers are a fairly chunky part of the distribution of our population. There'd be a bit of profit taking as well. But I think you can't really go to, say, 2 federal elections in a row talking about investors being the devil. You can't talk about in Queensland, we want to, tax investors not only for what they have here, but what they have around the country as well. And when they talk about the reasons why that was repealed, they didn't say because it was a bad idea. They said because the other states won't help us. That bloody Dominic bloke in New South Wales, he won't give us the data, so we can't do it. I mean, that's worrying for me. I mean, it's good that it's repealed, but it worries me that they didn't realise that that's actually a bad policy, because if the point is to make it better for renters, you need balance.
Yep.
And a 1%, which was the previous figure, April, I think 1.1% national vacancy rate, that's crisis levels. 2 to 3, like 2 is considered on the tighter side of balance. 3 is probably a little bit more balanced, but at 1%, it's a terrible thing for I think society. And what is the serious side of this? It's homelessness, right?
That's right.
And it's demographics that are quite heartbreaking to hear about. It's typically it's going to be middle-aged single women, for example. And I just think the politicians aren't doing enough to solve this problem. And investors are the easiest way to move the needle.
Yep.
We can talk supply till the cows come home. But encouraging investors to take a view that, they're somehow stealing from first home buyers.
They always want to seem to punish investors.
Yeah.
It's like it's almost like there's a mentality with some governments, you've got too much money, you shouldn't have that, we're going to take that from you.
Yeah.
We need to sharpen our pencil in that area.
Yeah.
Which is really frustrating, and it doesn't, as you rightly said, it's not helping.
Well, we're seeing the reverse of what's actually going to help. We're seeing the reverse. People are selling their investment properties, not getting more investors to buy properties. So how much, and I guess interest rates are something that we'd love to touch on with you, but how much is that still impacting investors' decision to sell? Are they still stung by those? We've been in this high interest rate environment for a little while.
Yeah.
How's that looking?
I think when people talk about rents rising, they assume that, that's just landlords passing on their increased costs. The data is saying that landlords aren't passing on 100% of that cost. It's probably closer to 2/3. And if you look at the API Property Investor Survey, they said basically 2/3 of people wouldn't up the rent and risk losing a quality tenant. So there's more to it than I think just interest rates. I think it's much more in and around the sentiment. And making it harder for investors because of the land tax, things like minimum standards legislation and no cause evictions. We're seeing the Prime Minister in the news because he's trying to move a tenant along.
Yeah, that was a bit of drama, that story, wasn't it? It was interesting.
I'm not 100% across that one, but hopefully that kind of brings a little bit more national focus on it. I think we can have the argument about whether housing is an asset class that we could or should invest in at some point.
Yep.
But right now, the government owns such a meaningless percentage of private rental accommodation. And you can go back all the way to the 70s. 1/3 of us are going to rent, right? And we kind of think of renting as like suboptimal, like, you're only renting because. But some people rent because they're new to the country and typically don't want to buy for a while because they want to establish employment and go, like, what is this place? Like, am I in
where
the
do
right
I want to
suburb?
buy?
Do I really want to be here?
Yeah.
And let's try before we buy.
And there's a gap between the perfect place that you want to live and the best investment category as well. And the banks have shown recently the biggest kind of cohort of investors is actually people like 25 to 35, that sort of point. And they are rent vesting, right?
Yes.
Because they decide they want to be close to things. So there's always going to be a demand for rental properties, not just because there are certain people who can't afford to pay a mortgage. There's people that that's just the way that they want to live.
Yeah, it's a very different mindset. It was back, there's always been a bit of a stigma attached. They're just tenants. We're just renting. Well, it's not just.
Yeah.
It is a strategy for many people, as you rightly said.
And I feel like the younger generation, they are going to choose to rent because they're going to choose to buy where they don't necessarily want to live because they can't afford to buy where they want to live.
Yeah.
So the younger generation aren't seeing it as that. Some of them are even making peace with the fact that, you know what, I'm not so worried about owning a home that I'm going to live in anymore. I mean, I've got children in, heading into their mid to late 20s and I hear the conversations. It's almost becoming unattainable. So,
well, we even look at the first home buyers that we help more and more. It's just a strategy. It's to get in the market, but they want a sensible decision.
Yeah.
And they're looking at it, okay, this is either going to be a stepping stone to where I actually want to get to, or this is my start of my portfolio. So I want to buy really well and ideally hold it for a period of, long term and then look at it down in the future and build actually a portfolio around it and spread the risk. So, more and more we're even seeing it where once upon a time, oh my God, we're buying our first home, and it was almost looked at like it was going to be their forever home. That was always, I guess, the general feeling around it, and mum and dad and everyone be involved, where now it's very different. There's a lot less emotion.
Yes.
It's more excitement that it's the first step.
Yeah.
But it's, the emotion, it's more, around, okay, this is step one and, or I'm never going to live there. I just need to get my foot in the door.
Yeah, and I think that's a worthwhile strategy. It's a great way for people to get involved because it's easier to buy an investment property because you've got a tenant that's contributing to the mortgage, so the banks 100%. Are going to look at you more favourably, right? So, housing, you can go back to the 20s and read articles saying housing's too expensive. It's unaffordable. All the way that far back, 100 years, it's always been difficult. There's, data out now saying the percentage of people spending their income on housing, and definitely it's hard, and it's hard it's been for a little while, but there's always a way. Where there's a will, there's a way. And I think if we really kind of want to balance this out and make housing something that is affordable, we make rental sort of in a balanced way, we need to look at some of the constraints that aren't about investors versus home buyers. Things like the percentage of taxes that go to creating new property, incentives for building because the cost of construction is so high. Developers aren't seeing margins on the projects. The pipelines of higher density work are way down. And there's just structural things like, stamp duties where the government's, the government gets basically $1 billion a week in stamp duty. It's like 51 billion in the last financial year. I mean, these are huge numbers.
Massive.
And it's impediments to the healthy kind of flow of people from property. Like Alan Kohler shared something on ABC about the percentage of two-person households living in 4-bedroom houses. Now, stamp duty is one of those kind of, I think it's almost like a tax on mobility. And then, of course, you've got planning. Do we need to go to more high density, lower block size? There's impediments with local governments and then state oversight where they can come in and overrule certain councils. There's a quagmire of stuff that needs to be looked at. And so it's not as simple as investors are the devil.
When I spent quite a number of years in development here on the Central Coast, the local council was the problem, even so much so that, when the Gosford story, it was a bit around, it's on its way now. There's some big developers in town and it's better. But way back before it really Gosford started to regenerate, the city developers didn't want to deal with the Central Coast Council. They were a nightmare. And they had so many blockages in place. So it took developers with the cash to come in and actually be able to do it, to navigate around banks and the blockages are there. Which is another question I've got for you, and I know you'll be all over this, but construction costs. We're hearing from our clients on a very small scale, the ones that want to renovate, the eye-watering numbers that are coming in. Are those construction costs coming down a little bit, do you think, or are they still right up there?
Well, if we go back to COVID, the first increase in construction costs was materials, and that was all about international shipping. So there's an index called the Freightos Baltic Index, which is the cost to move shipping containers around the country. That went through the roof. It's now basically back to what it was pre-COVID.
Right.
And 60% or thereabouts of our construction materials they're sourced outside of Australia. We haven't done enough to invest in certain things like timber. We've lost a lot of timber with natural disasters and those sorts of things. So materials have, there's lumpiness here and there depending on what you're talking about. But in broad terms, it's back to what it was. Now it's a labour shortage, which is exacerbated by a number of different things. One of them is natural disasters. People don't quite understand the impact of natural disasters on our supply of construction labour. I've spoken to, top national home builders, household names that you would know, saying, we can't get roofers. And like, what do you mean you can't get roofers? You're XYZ building company. That'd be a dream ticket for a roofer because you'll just work with them forever and retire. And they're like, well, when the insurance company's paying double the hourly rate, like there's nothing we can do. Because if you think about insurance, there's a cost to kind of rehouse the displaced people when their houses are damaged. So the insurance companies are always, they've got a vested interest in getting people back into that property as quick as possible. So in the natural disasters, we're still dealing with that. There's still kind of tent cities from the bushfires back in 2019, crazy stuff like that you hear. And at the moment, construction labour is constrained by this huge pipeline of infrastructure projects, government work, right? We've got some of the rail stuff in Victoria, which has been on the news as a problematic project. Western Sydney Airport, Sunshine Coast Rail, the Inland Rail in New South Wales. Lots of these huge, big nation-building style things that are actually competing. And you hear these stories about lollipop people on $200,000 a year, and that's kind of a reality, right? And of course, with COVID, we saw I mean, people forget at COVID, we didn't really know what was going to happen. Like, do we buy baked beans? Do we get a shotgun? Will there be zombies in the street, you know? Do we need more toilet paper? The answer is
It's bizarre when you think back about it.
There couldn't be enough toilet paper.
yeah.
You think back to some of the things that happened and it's like, did that really happen?
I wrote a LinkedIn post called The Economics of Toilet Paper Supply in Australia. And I thought, like, that shouldn't leap off the page. And I never thought I'd write something like that. But I wanted to investigate, like, do we need to panic? But most of it's domestically produced, and it's all about the just-in-time model. They don't have a big warehouse. They just get a small amount behind the scenes. They bring it out, and it rolls perfectly. So if we all just behave normally, no toilet paper problem.
Ever explained the toilet paper story, why the country went nuts over it? Has anyone ever unpacked that?
Yeah, look, I guess it's just one of those things, like, we can go without things, but when you need to go to the bathroom,
Simple as that.
it's a pretty highly prized thing. But yeah, I mean, that was an insight into how kind of crazy the world was. And builders were securing a pipeline of work on low margins, right? Like, all right, well, let's just go to tender for this. We'll do it at 6% margin, and so that we can just keep our trades paid, we can keep rolling. Then you see like a 20% increase in costs. Like, not only does it erode the margin, but it becomes unprofitable. You know, and we saw like 3,500 builders go into liquidation last financial year. We're on track for 1,400 at this point in time.
It's going to increase. Yeah,
it's crazy. The core logic construction costs index has said 0.8% for the last 2 quarters in a row. So broadly kind of tracking inflation, but I don't think that's the true story on the ground. You hear much more of the anecdotal stuff with it. It's like, I mean, we know construction costs went up and then they've kind of stayed there. They're not coming back. They're not growing as quick as they were, but it's kind of lumpy. Like, there are certain areas where the builders can just kind of cherry pick the sort of stuff they want to do. They don't want to do high rise because that doesn't work financially. They don't want to do certain reno projects because it's a bit too
Well, we're hearing that across the board. Like, certainly in our area, a lot of builders that we know once upon a time would take on a type of project are not. They're becoming very specific, or a lot more specific around what they will do and what they won't do, and at what value they will take on a job. Yeah. Anything below a certain value, they're not interested.
Not worth it. Yeah, and in our data, we've tracked it in the last couple of years. We saw the percentage of people that made some improvements to their rental property was around about the 30% down to about 16%. Right. And not only are they less people doing renovations, they're actually spending a lot less as well. So I'm guessing that kind of flows through to you, like where you might have had briefs where it's like, oh, I don't mind a bit of a fixer-upper, and now it's like, well, no, it's so expensive to fix things up.
Yeah. It's definitely changed the landscape. So we're hearing again out there, they're either scaling back significantly, or they're doing it in stages, or they're selling and buying something done.
Yeah. And you don't hear about flipping anymore.
No.
Well, interestingly though, we've been to a number of properties, and this is the thing that blows my mind quite. So they've been builders and in construction for a very long time, and they're buying projects, so knockdown and rebuilds, and the money that they're investing, like we walk through, don't we, and we're thinking, how are they going to get their money back? And then when we talk to the selling agent, they're actually not. They're actually coming in but it's more they're doing it as a passion, because if you're not going to make money out of it, why go to all the there's a lot of passion builders out there, because it's getting harder and harder. The buy-in's so high to start with, then you've got all the other stuff on top. There's no such thing as a flip.
What we're seeing is more often than not, clients that do want to renovate are getting their quotes and scaling back. We can say it to a degree, but until they get the numbers in front of them, they're like, whoa, okay, that's too much, I'll scale it back. What we are seeing, what buyers we're seeing don't want is extensions. They don't want construction. If they can buy a house that's very livable and it needs a kitchen and a bathroom, they'll live with that. They'll go, you know what, I can move in, I can paint and do a few things, and then I can do that. What they don't want is second stories, extensions, that are major structural things, because they can't wait. The house might be too small for them, and they literally can't live in it without that extension. So they're just buying and waiting It's just they don't want to invest that huge money, and that's where we find the big costs are coming in when you're adding structure.
And I expect that to be a trend that sticks for some time. I mean, we need a lot more tradies. Master builders have commented on this. The big press release from the big capital building, 1.2 million homes in 5 years. That's due to start 1 July. That's a pace of construction we've only ever hit once ever in an isolated year. They're trying to do 5 years in a row. When we have higher interest rates, higher than neutral, at least the RBA is saying now. We've got natural disasters, we've got the big infrastructure projects, we've got a lot of builders that have gone bankrupt. It seems to be over before it's even begun as a bit of a target.
Oh, God, we could go and talk about this for ages. It goes around and around.
My mind's thinking there's so many offshoots we could go on, but, we'll probably be here all day. We could just crack open the bottle and away we go. But we know you're on a time limit, Mike. But, yeah, it's just there's so many different areas it goes into it. And, not to forget all those people that builders have gone broke. What are those guys doing to finish their homes? Yeah, they're stuck halfway through. What do they do?
And that is a real hard situation that I think people don't necessarily understand. Like the banks understand when they're funding a construction project because they hire quantity surveyors like us to make sure that the project can be built for what they say it can be built for, and then that the funds are only released based on works fixed to site. And one thing that the banks always maintain is a cost to complete. Their nightmare scenario is that the builder or the developer goes bankrupt or walks off site, and then they have to finish the construction, because what happens if it's half constructed? The next party doesn't come in and go, oh, it's 60% built, then we'll just charge you 40% of what that cost was, because they're assuming the liability and the risk done by the previous person. And things like waterproofing that you can't really inspect once you've done the wet areas. When we were first seeing these issues and people were asking us for advice, where the builder's saying, look, our costs have increased, it's not part of the contract. We had a fixed price, but, we're asking you to chip in for part of these costs. I mean, our advice in a lot of places was do it, right? Because the alternative of that builder going bankrupt and being in that situation where it's going to cost you a hell of a lot more to try and get that up and running, it was a difficult situation for people. And now we see construction contracts have little clauses in them to say there's a plus minus based on materials as well.
There's a few more significant developments on the Central Coast that are sitting there where, they're for sale, but they're multi-story, apartments. The new owner has to assume that risk, and there's not too many out there that want to do that. You can't see what's under the ground, and under the ground's done, and it's up above podium. So, they're hard to move.
And we've seen plenty of issues in and around build qualities, like we're going back pre-COVID now, but opal towers, mascot towers, and we got some of the flammable cladding issues, and that chappie with the tactical vest going inspecting places in Victoria, finding all these cowboy tradies, that is a cause for concern. And, we don't have enough trades.
Well, we don't. That's what I was going to start on. Then I thought, am I going down another rabbit hole? Because my husband's in construction, and another massive problem, they can't get labourers. So young kids coming into the workforce now don't want to do that hard work. So they've got no support. So they're finding fully qualified tradespeople being the labourer and the tradesperson. And then, of course, the costs are higher for that because the qualified trades, a lot more glamorous positions out there now than doing hard work like that. So people are attracted to other areas and other professions. Totally, 100%.
Not exactly an attractive role, but the remuneration's attractive.
It's always been renowned as a very high-paid role, the lollipop person.
Yeah.
So it's all of that bundled in.
Yeah, and I suppose you think about apprenticeships. I mean, the recent budget that we had, which is there's a whole other episode when we talk about the budget.
Go down that rabbit hole. You'd be great to talk to about that.
What they did show or announce is that there are sort of vet fee or free, basically, TAFE things for increasing participation with apprenticeships. I mean, we need around about 90,000 trades a year to fill the deficit. And I think in last financial year, we had 55,000 apprenticeships basically quit or didn't go to fruition because it's quite hard, and it's you are starting at the bottom. There's all those kind of hazing style stories, and even if there isn't kind of institutional bullying like that we used to see, hopefully it doesn't exist anymore, you are still kind of the bottom of the pile and get treated as such. But then you get to a point, where you are a qualified tradie that you can kind of write your own ticket. I remember when I was young, my dad said, always get a trade, son, because you'll always be all right. And I was like, get lost, Dad. I'm going to uni. Like, I can do better than a trade. And now I'm kind of thinking, geez, I should have got a trade. It's where the money is.
You see all those guys that did get trades and they're like flying. You're like, I don't know. Is it not attractive to the young people anymore? There's so many other options open to them now. Everyone wants a laptop life and be an influencer. Like there's so many other things. But that is a point. There are other things, a lot more avenues open to young people now.
Yeah.
The world's smaller. You can go work from anywhere.
But there's other professions that when you start out, because let's face it, when you're young, it's about the here and the now. You don't think future was that. That's way down the track. So it's the here and now. And you look at some professions when you first leave school, they're paying a lot of money for a kid, essentially. So kind of like, I could go and do that and earn that now. Or that's hard work and I'm going to be, the shit kicker, so to speak, and I'll be at the bottom of the run.
What you want to do as well. I still don't know what I want to do when I grow up.
We're all in that same boat. When are you grown up?
Yeah.
When does that happen?
It hasn't happened yet.
Well, that's good. Well, I guess something that we probably should have really talked about when I introduced you is, what is your business? Is it that you're talking from a very place of expertise? But MCG, quantity surveyors.
Yeah, I mean, a lot of stuff.
Help people.
Yeah, a lot of stuff I talk about is just my own curiosity. It leads me down the rabbit holes to investigate things, but it all kind of broadly ties back to our area of expertise. And a lot of the stuff, the observations are our own data, like where people live, from where they invest and which states they're going in. So we are construction cost estimators. So any reason why you would need to know how much it costs to build something, there's probably something we can sell you. Well, isn't this a great sales pitch? But my
go ahead, give it your best shot.
Yeah, I've already ruined it. My particular area of expertise is tax depreciation, which is kind of a construction accounting hybrid sort of thing. So we have to be registered tax agents. We can't do tax returns or give you accounting advice. But when you do a depreciation schedule, you are putting depreciation rates on an asset that's given to us by the tax commissioner. So we help property investors maximize their cash flow by claiming the deductions that they're entitled to. And I know you guys like data, so I'll give you a little juicy bit of data. A couple of years ago, we did a research project where we looked at 1,000 residential investment properties, and we were trying to see missed deductions, because you can backclaim 2 financial years worth of data, but if you wait longer than that, you're basically setting fire to those deductions. So in that 1,000 investors, we found 6.7% of them waited so long that they missed out on some claim.
Right.
One particular lady bought a unit off the plan 16 years before she contacted us about her depreciation. And that was kind of like 60, 70 grand of missed deductions.
That's all the big stuff, too, in the early days.
Yeah. Do you got a big back claim for the 2 years? And I'm like, oh, that's really good. But in my heart of hearts, I'm like, oh, but you missed so much, so much. But of the 6.7% of people, the average that they missed out was $20,537. Now, at the time, because journalists love clickbait, we thought, let's extrapolate that over the whole investor population. And it worked out to be $2.88 billion worth of unclaimed deductions. Now, I kind of think, sometimes people have kind of heckled at me like, oh, people should pay their taxes. I'm like, yeah, absolutely. I believe in that system. There's issues around bracket creep where I think we need to tweak some things. But yeah, like we all need to participate in the upkeep and the security of the nation. But these are entitlements that you're given. This is legislation that's been around, as far as I'm aware, in the 1920s and 1930s. So if you want to give money away, I say give it to a charity. Don't give it to the government. They'll just waste it. I mean, you don't have to look very far to see examples of wasted government money. Those shovels that they use to turn over the first clod, they look expensive. Those giant scissors.
They are expensive, those shovels. Yeah? They actually are. I've actually been involved in buying one of those.
Have you?
And they are very expensive depending on how solid gold you want. But very expensive. Yeah, that's a really interesting statistic, isn't it? I mean, a lot of people don't know about a depreciation schedule. When we purchase for our investors, obviously we love working with you guys and introducing you, because a lot of people just don't know.
On average, it normally sits around the high $9,000 worth of deductions in the first year of claim. So you buy an investment property, you rent it out for a year, on average $9,000. And of course, that's not what you get back in your pocket. It depends on your marginal rate, but it could easily be, $3,500 back in your pocket. And that's just 1 year. It goes for 40 years. Yep. And what that really is, and we saw it in the ATO tax stats, that's the government sort of recognising the fact that you are providing a service, you are providing housing. It's bloody expensive for the government to do that. They own around about 330,000 rental properties. That hasn't really changed in the last 10 years. We might see negative gearing losses in the news. Typically, they're around about $3 billion a year. In the ATO tax stats 2021, there was actually a net profit by property investors. So negative gearing was actually not a thing in 2021 because of the extremely low interest rates. But you don't hear that in the media. They go, this year investors cost the government. Oh, wait, they didn't cost the government anything, and they provided rental accommodation. What do they do to thank them? We're going to increase land tax. Yep. We're going to say they're the devil. They're the reason why people can't buy their first home. We need some more nuanced debate, I think.
We've always said Mike for Prime Minister, haven't we? Yeah.
I think I've got enough trouble and probably too many skeletons in the closet. I reckon like day one they go...
No one cares about that anymore. Everyone's got skeletons. There's some pretty
dodgy
scary ones out there and at the moment. So.
Yeah, true. Yeah.
No, you would.
So So with our clients too that buy investment properties, you guys are great. You'll have a quick look over as well before they go into full. Let's do a depreciation schedule. You'll have a high-level look at the property and say, look, yes, we think it's worth doing, or no, it's not. So that's a really good service, I think,
we won't do the report if there's no value. We just say, we've crunched the numbers. This one's probably not going to stick for you. Yeah. It doesn't happen that often, but it does happen.
Which is nice. Yeah. It's a good service.
But for people that kind of thinking, gee, I wonder if my property is worthwhile, I came up with sort of 3 triggers I'd love to share with you guys. If it matches any of these 3 things, there's going to be value. The first one is you buy a brand new property. That's not happening as much as it used to. Around about 49% of investors back in 2017-18 were buying brand new. Now it's sort of, it's in the teens. But if you buy brand new, it means you get to claim the structure and the plant and equipment items like the ovens and the cooktops. The second trigger is if it's built after the 16th of September 1987. Forget that date. Just think 87, sorry. Ruined my own tips. 1987, because if it's built after 87, it means you can claim the original structure. So that's the bricks, the concrete, the timber, and 2.5% of that. Let's say it cost $100,000 for that in 1990. You're getting 2.5% each year, so that's $2,500 of deductions each year. So if it doesn't match 1 or 2, it's not brand new, it's not built after 87, we then need to look at the history of the property. There are people that will say, it was built in the 60s, so there's no depreciation. But it could have had an extension or a new kitchen or a new bathroom. Like if you think about a property built in the early 80s, it doesn't make sense for it to sit there unrenovated. You get a poorer quality of tenant, you get poorer return for rent. If the bank goes to revalue it, it's not really as presented as well as it can be. So most properties are renovated, and we look at a magic figure of about 40 or 50 grand, because $40,000 worth of structural improvements at 2.5% is $1,000 a year, and that's about the break-even point for a schedule. 40 or 50 grand used to be a kitchen and bathroom reno. Now it's like a plumber's call-out fee. You don't get much for the money. It's good to have a husband in construction right now.
That sometimes doesn't help because of the materials.
True.
So, no.
And tradies are always their own house is always the last house they do anything to as well.
It's like the mechanic's wife's car that just never runs.
I was just going to say, not only do you offer all those fantastic services, but one thing we found really interesting, I think you spoke about it at one of the REBA conferences, which a lot of buyers agents in the room were quite interested to hear, was about home insurance. And I know you've been doing a podcast on it lately with your business partner, Marty, but tell us about that, because a lot of people don't know that they're perhaps underinsured or what the repercussions of that are. I certainly did not know. And I know a lot of other people didn't.
It's a bit of a passion project for us. It's obviously a service that we provide. We don't make much money on it. Hopefully that'll change over time. But we care about it so much that we're just more about getting the message out there and trying to help people. Because it's easy to pay $600 or $700 for a depreciation schedule and get, say, $5,000 back. But if you're paying the same amount to make sure that you're adequately insured, it's like, oh, where's the fun in that? Maybe my premium's got to go up. But I feel like there's got to be a balance. We want to maximize the deductions, but we want to protect those assets. There's so much focus on building the asset base, building a portfolio, but very little on protection. The Insurance Council of Australia came out pre-COVID and said that 83% of homeowners are underinsured. And that was, of course, prior to that huge increase in construction costs. So there hasn't been an update on that number, but you could safely assume it's going to be 90% plus. Marty did some analysis where he looked at online calculators and found like over 100% variance on a project where we knew the exact construction cost and we plugged them in. The recent data sample that he put together showed that on average, we looked at a couple of thousand reports where we knew the exact sum insured. That policy was provided to us by the property owner. This is across resi and commercial. And then we compared that to the report where we said this is what the insured amount should be. And it worked out to about 24% underinsurance across the board. And these are mostly sophisticated investors, because I think you've got to have a level of sophistication to look into this, especially commercial, where there are insurance brokers making sure the policies are fit for purpose. But residential property owners and investors, they tend not to have a broker working for them in insurance. No. They do in mortgage, but not in the insurance space. So it's a real concern for us. And what people don't necessarily understand is that you can look at an ad for a new build home on TV and go, oh, that's way better than my house. I'll just insure it for that. Or I'll insure my place for what I paid for it, and there was free land in that, so that's probably enough to balance it out. Those are fairly unsophisticated strategies. But
I don't know if anyone really has a strategy. This is the thing. Everyone jumps on the online calculator, which you've done the research on. It's clearly not all the time. Our buyers ring us and go, "How much shall I've got? I'm doing the insurance for our house. What should we put on there?"
Yeah, and the best you can hope if you give any advice is to be sued if something happens, right? Exactly. But it's a hard situation, and there's no real solution other than going out and inspecting it, because there are costs that you wouldn't consider, like demolition costs. The actual orientation and the conditions of the site impacted as well, because it might need a traffic management assessment. It might be something that is built in an area that now has new regulations around fire or flooding. It might need to be built higher up. It might have been built too close to the boundary, which was fine when it was established, but you can't build it like that again. There's the cost of going to tender and the price escalations throughout the construction as well. There's a lot of different things that people don't consider. It's not just build it on a perfectly flat level block where everything's ready to go. So that's something that we're passionate about, is letting people know, sure, build the assets, build the portfolio, but you've got to protect these things as well. Because Mother Nature's quite angry at what we've been up to in the last little while.
She's not impressed.
And if you happen to live on the Central Coast, pretty much the entire place is now in the 1 in 100 flood mapping. So if you even want to put an extension on, you're now subject to different development controls. With the nature of our region is water. Yeah. So as you're not too far away from us, your hometown. So it's a big consideration.
There was an interesting point that you made at that talk, and I think it was something to do with you can't just assume actually
the payout.
Yeah, the payout.
So if you're underinsured, what are the repercussions in the payout figure?
I was just wondering if you forgot it because it was in the Barossa Valley. And
I think it was. Do you know what? That point hit me more than anything.
I did. That's why I was looking at you, because you were really like, and it's just not.
Did I misunderstand that, or is that actually the case? That if you're underinsured by a percentage, they will pay you out less that percentage that you're underinsured. That shocked me, because that hurts the hip pocket. All of a sudden, you're underinsured, and then you're not even going to get paid out what you're insured for. Yeah. Can you run us through that?
It's called the co-insurance clause, and it's pretty much in every policy as far as I understand it. So what that means is that, let's say you've got a house that would cost $1 million to rebuild, and you have it insured for $800,000. if that was to burn down or be demolished, the insurance company would say, okay, well, you've elected to underinsure that by 20%. So what we're going to do is we're going to give you 20% less than the insured amount you have with us.
Wow.
So they're going to take 20% off that 800,000. So the reality is most people are going to get a tap on the shoulder to say, you can't rebuild this for the insurance policy that you have, and you'll have to chip into your pocket. It's a sneaky little policy.
That really, that's cemented into my brain that day, and wow. Yeah, that's a really interesting one. I would beg to differ that most people, 99% of people, do not know that.
Yeah,
their insurance
think
policy.
You're right.
Who reads the whole PDS? Who reads the whole book? I haven't read enough of it. You can't understand it because it talks in riddles.
You only get engineers reading that sort of stuff. Like
you read it, don't you, Mike?
You're saying I have no social life. You can tell by all the data I've shared.
I love your data. It's fantastic. No, I just thought that is a really good point to share with our listeners because it might just instigate, having it's worth that $600 to come out or whatever it is to come out and say, look, this is the reality of what it would cost to build your house. If your premium goes up, well, probably needs to go up.
It's a bit of a hard thing at the moment because in general, insurance premiums have gone up very, very rapidly, and that's feeding into inflation as well. It's kind of one of the measures. So it's hard for people to consider, well, all right, well, maybe I'm underdone and my premium might need to go up. But at the end of the day, it's like, what is the cost of having that security that if something happened, you would be able to reinstate?
Do I ride the gauntlet or do I? That's kind of what it is.
We had a client, a sophisticated client who owned an accounting practice, and she got us to do an insurance replacement cost plan on her house, and she had a bit of an acreage. She had horses and stuff. And we said, okay, well, it'd cost X to reinstate all of this. And she's like, oh, that's great. I'm going to insure it for X minus 30%. I'm like, that's not our intention of how this kind of works. She's like, no, like my premium needs to go up, but I've got enough cash and resources that's where I'm comfortable with the risk play. And I'm like, well, I mean, each to their own. If she's got money stashed away, but at least she intellectually knows the position that she's in and she's fine with it. But most homeowners really are probably in the dark. Are they covered? Are they not? Are they overinsured? Are they underinsured? And the stats really point to the fact of them being quite heavily underinsured.
What if you're overinsured? Is there any?
Well, you can reduce your insured amount.
But if your house was to burn down and you were overinsured?
I don't think you get to pocket the surplus. That would be nice. Insurance companies just have a way of taking the fun out of everything.
They just don't ask.
You know what? It was kind of...
There'll be a term and conditioner tucked in there somewhere. So you get a much better house because you're...
Wouldn't it be nice? Or you just get it in
rebuilt?
Cash.
Yeah, that'd be nice.
You know, one thing I observed back... Do you remember when we were sort of having fairly robust debate internationally about whether climate change was real? I think...
Aren't we still having that debate?
Unfortunately, in some circles, yes. I think the data has kind of given us some categorical evidence. But you know who wasn't arguing about whether it's real or not in the beginning was insurance companies. They were talking about it for years and years and years. They were plugged into these climate models because they have to factor in, the capacity for losses, their risk exposure. I found that really interesting. They're watching the whole world debate about, you've got Al Gore and then the other side going, like the sea levels are rising. I'm like, that's just because, more penguins are putting it up or something. But the insurance company this is real. We are seeing more natural disasters. We're seeing more extreme weather events. So we're planning for it.
We totally are seeing more of those events, aren't we? Yeah. They're on the regular now.
So in your capacity, you're also very much involved with a number of organisations. So in your recent appointment on the PIPA board.
Yeah.
So I guess tell us about some of the work that or some of the ways that you can see your association with REBA, Real Estate Buyers Agency Association, PIPA, Property Investment Professionals of Australia.
It's a mouthful, isn't it?
It is. Well, it is. I can never get it out.
I'm going to get it tongue-tied.
But I guess the listeners probably don't know what PIPA is, so that's why I had to explain that. We tend to use these acronyms and get reminded. Please spell it out. What that actually means.
It's not a household name yet. Yeah, look, REBA is really essentially run by buyers agents. I'm not a buyers agent, so I've never been part of the organising committee. I'm sort of a sounding board to I was friends with the previous president, friends with the current president. Some of the committee will call me and go, what do you reckon about this? Or have you ever come across this person? I'm like, oh, yeah. But I've been an affiliate member for a long time and spoken at a few conferences. I'll be speaking at the upcoming one. I found out yesterday. You probably knew well before I did.
I did. Well, I was like, have you asked yet? Because I'm seeing him tomorrow.
Well, thank you. I'm sure you put in a vote for me. But my association with REBA to begin with was I kind of wanted to pitch my flag somewhere because I see buyer's agents as a business or as a industry. It's just expanding so rapidly. And unfortunately, in my view, the barrier to entry is way too low. Yep. These are very, very serious financial decisions, as we sort of prefaced before. Much more serious to the individual than a lot of the stuff that we do. Now, maybe big construction projects where we're releasing funds, there's an argument there to say that it's high stakes, but in the tax stuff, it's minuscule. Yet we have to do a 3 or 4 year university degree and all sorts of CPD and that sort of stuff just to provide, the effective life of carbon is 8 years.
Yeah, it's a very good point, and it's obviously a hot topic.
Well, yeah, it is. I had a chapter meeting with the Real Estate Institute in New South Wales yesterday, and it's one of the hot topics we talk about at each meeting is barriers to entry and how we can increase training and education and ongoing CPD and all those sorts of things. Yeah.
And there has been some good work done by certain national bodies. I think we could go a lot further for many of the ones that have even had a step forward, but, of course, sometimes things go slowly. So PIPA is a similar sort of organisation to REBA, but it's not just buyer's agents, whereas every REBA member is a buyer's agent. With PIPA, it's property investment professionals. So lots of buyer's agents in the mix, but you've got mortgage brokers and financial planners and accountants and that sort of thing. So what we are really doing is trying to advocate for minimum standards, and with the Qualified Property Investment Advisor course, that's kind of something that's put out there to hold people to account with their professional standards, to upskill them to the point where they can represent their clients in a meaningful and safe way. So I was invited to jump on the board a couple of months ago and spoke at the conference in Brisbane a couple of weeks ago. I'm good friends with a bunch of the other board members and the chair, Nicola, as well. She's a real powerhouse lady. She's great. So I'm just enjoying that. And I think in the lead up to the next federal election, we've already seen some bubbling around negative gearing. We've seen a few people coming in and wanting to tinker around the margins. There's some policies around rental freezes that I think maybe sort of formulated in good faith, but I don't think the participants understand the unintended consequences that can come with that. And I think we've already seen, we've disincentivized investors in a meaningful way in certain states, and we've kind of there's been a lot of rhetoric around, the harm that investors do to anyone else that doesn't own a property. And the result of that, less investors have participated and investors have sold. And what's happened to vacancy rates? Well, we've reached crisis levels of rental accommodation. And with private rentals being 91% owned by mum and dad investors, or that's probably an outdated term now, mum and mum investors, dad and dad investors, who really are private human beings.
Partner and partner.
Yeah, we're going to update that one.
Yeah, we probably do actually.
Yeah. But but that just goes to show it's people like us, right? People that own investment properties that provide that accommodation. There's a part to play for investors, and yes, we need to protect tenants. They shouldn't be second-class citizens. I mean, I used to go and inspect properties and people would say, I'm only renting here because I'm building that, or I rent here but I do this. It's almost like, don't look at me like a scumbag. I've got other stuff coming
that's like
on.
You have to justify
I think it's quite shameful that people feel that way. And that's, an institutional kind of thing that we need to change.
Agreed.
But we need investors, so we need people to advocate for the value that they're doing. So that's kind of where I see my role with PIPA.
It's great. Well, you always add so much. Obviously when I was at the REBA conference, and we'll be at we were at the PIPA one last year as well in Sydney. But it's always your input's valuable, and it's so great to have such good experience on the board, bringing your perspective I mean, we love it. I could listen to you all day. Like you've got
Gosh, we could unravel so many topics
to say and so much value to add.
Yeah.
So it's really great to see you involved. And you're a bunch of fun. We always have fun at the Reba conferences.
Yeah,
it's coming up this year in August in Sydney. And
Linda won't have as much fun as you and I will.
No, Linda has to MC the event.
I am.
Because that's a new thing, right? The state reps are emceeing the events. It's a new...
It is.
Yeah, so maybe next year we'll get into...
Don't worry, she punished me and threw me into a...
Don't worry, I've got my wingman.
She punished me and threw me into a facilitation of something. I thought, that'll be right. I knew she'd throw me into something.
Totally, watch out.
I've only got, I think, a 15-minute presentation and then I'm relaxed. And Melinda, the current president, said, like, do you want to do day 1 or day 2? And I'm like, Melinda, day 1. Come on.
No, there's good speakers and it should be a great event. So
everyone gets a bit excited on day 1.
Yeah.
Yeah, they do. But no, we love it and we love being involved in it. And as the industry grows, it's going to get bigger. And
I feel like we're at it's a real changing of the landscape. Like we can see the transition, happening. So I guess a lot of the work that we're also doing from our perspective is around, okay, what does the future look like? We can't stop it. So how do we support it, but support it in the right way and make sure everyone has the right credentials, the right training, and, to take it. And it's also the birth of other services along the way. We can't stop that either because the market demands those services. So, okay, how do we work to support those services in the right way?
Yeah, and you ought to be commended for that because you don't get paid for this. It is quite a lot of work. You are only doing it because you actually want to see change for the positive. And, you guys came into Reba. I remember your first conference there and
Was that Brisbane?
Well, actually, I missed Brisbane. That's the only one that I've missed.
It must have been in South Australia.
It might have been, yeah. Well, you guys were interviewed and you're already participating straight
on
away.
A panel.
And then,
I think they found us quite fascinating. This beast. Because, well, look, we actually love, you and your business partner have a great relationship and have been in business a long time. And I think people find successful business partnerships quite fascinating because they are hard to find and they are hard to maintain, and a lot of them fail, which is really sad. So we have a great, business relationship, and so do you guys. And that, I think some people find it quite fascinating. They want to get to the bottom of it. How do you do it? How does it work?
And you guys do finish each other's sentences, which is very cute.
We were friends for a long time before we were. I know. So I think it kind of, but it is quite funny.
Siri thinks we're the same.
Is that? Wow.
I can't say. If we're in the car together, we can't say, hey, Siri, without both phones. So both our phones call the person.
See, my kids try and do that all the time because I use it. And then they go and my 3-year-old is like, hey, Siri. It's like, she doesn't even have a chance. She's got to get that diction right. But my boy who's older, he'll try and ask questions about dinosaurs and Siri has none of it. So obviously the voice has got to be close. So you guys are...
Well, there you go. I thought it happened all the time to everyone, but it happens to our phones. Siri can't tell the difference.
Right. You probably spend so much time together where it's like, I don't know.
I think we do. We even live in the same street now, so...
You guys need your own sitcom.
That's why we started a podcast.
Yeah. Close enough.
We can't actually see each other's house. We don't walk out the front and go, morning. Yeah. I'm up one end and Linda's down the other. But yeah, people do find us, I think, sometimes quite fascinating. Maybe they did at Reba. I don't know.
No, they did.
Yeah, we certainly made an entry, I remember.
No, they're always good fun. And I think Reba is there's positives and negatives to it, the exclusivity to it. Like, it'll never be a huge organisation because it is just buyer's agents. And I know I've talked about them kind of exploding. And then some of the standards to actually get in of Reba are part of what makes it great. But of course, it has to exclude some people that don't have the experience, or they are also a selling agent, which Reba takes a dim view on because it's like,
not a great
which side of the ticket do you want to clip?
Decide what side of the fence you want to be on, because you can't do both. And it's like any industry when it takes off. And I feel like buyer's agents, they have been around a long time. We know that. Big companies like Cohen Handler, but it is recent times where it's really kind of started to escalate. And there is people jumping on the bandwagon. You get the calls. How quick can I be a buyer's agent? They have no experience. They never bought a house.
Time frame.
Yeah.
Well, it does.
How
It's
quick
called the
can I get my
duration
license?
to get experience.
Yeah.
You can't just get out there and wing it with people's money.
Because
Yeah.
we feel like we could go, if we knew nothing about it, we could go and get a license tomorrow and be absolutely nowhere with it. We draw on our experience every single day. If we didn't have that, you just don't know. You don't know what you don't know.
And I think sometimes industry people kind of look at the consumer and go, oh, like what did you expect when you went for XYZ buyer's agents? But it's hard for the consumers who don't understand it. They don't do it every day. They don't know which questions to ask. They don't know how to tell whether someone's sophisticated or not. And sometimes, you know, the amount of properties that they own, you know, that might not even be the truth that's shared out there. I've certainly seen some evidence of people talking about the size of their portfolio, which is a fallacy. So that's what kind of drives me is always thinking about the consumer. What do they deserve? How should they be protected? And how do we get them to where they want to be, which is not, you know, one of the, 72.5% of people that only own one property.
No, absolutely.
So you have shared so much with us today.
Too much, maybe.
No, I think honestly,
You haven't even scratched the surface, really. About
We've done page one, surely.
multitude of topics. Come back again.
I'll come back for sure.
Yeah. But our audience will get a lot of value out of what you've shared. So if anyone listening does want to find you, where can they find you?
Guys, just be careful, because once you've been in my spider net, it's hard to get out. Everyone just tells me, like, once you sort of interact with me, then you see me everywhere. But, I'm on Facebook and LinkedIn. The business is MCG Quantity Surveyors, mcgqs.com.au. And if you follow us on any of those channels, you see a lot of our data releases and that sort of stuff as well, which I think they're interesting. So, I'd love to interact with anyone.
Thank you so much.
Thank you so much, Mike. Really appreciate your time.
Congrats on the success for the show as well.
Thank you. And we look forward to seeing you next time.
We hope you enjoyed this episode of Unreal Estate. If there is someone you think could benefit from the information that we've shared today, please feel free to share this episode or leave us a comment. We'd love to hear your feedback. We release a new episode every 2 weeks, so stay up to date, hit follow or subscribe, and we'll see you in the next one.